Thank you all for attending. Yes, I am extremely excited about the opportunity for everybody to have the chance to listen to Dr. Menaker. He's got a wonderful presentation followed by some question and answer. Again, I'm really happy, and I feel like we are really blessed to have the good doctor with us here at Top Step and here ready to answer our questions. You know, like Kelsey said, he's an active trader. He's a clinical psychologist working mostly with institutional traders. Now, we had the blessing to work with Dr. Menaker a few years ago. He is back. We don't often get the opportunity to ask questions of such a professional, so make sure you have your questions ready. Dr. Menaker, how are you today? I'm not able to hear him.
Here we go. I had myself
Hi,
muted.
Doctor?
Yes, can you hear me now?
We've got you. How are you?
I'm very good, thank you. How are you guys?
Doing well today, doing well. I'm very excited to have you with us, Doctor.
I'm very glad to be here.
So you and I were talking just a couple of days ago, and you mentioned something that I thought would be really kind of interesting to start the day off with. And you know, through survey, you said that traders say that the importance of trading psychology is about 70%. According to survey of actual traders, 70% of
on average. Like some say 90, some say 50, but it comes out to being the mean's usually around 70%.
So 70% are placing the importance of trading psychology overall in an average at 70%. How many put effort? How much effort is put into trading psychology, Doctor?
This is where it gets interesting. If you ask those same traders who average 70% trading psychology is important, they typically will give you a 10 or 20% number in terms of what they commit in terms of their energy and attention and actual efforts around trading psychology. Big disconnect.
It's amazing, isn't it?
Yeah.
Everybody knows how important it is, but people don't do the work.
Yeah, you know, it's interesting. I'm not a little bit of an analogy. I'm not a golfer, but friends of mine who golf say, if you're struggling with your putting game, you go out there and you practice your putting. But traders, if they know what they're struggling with, they typically don't go and work on what they're struggling with. It's kind of, I'm not quite sure why, but well, I have a few ideas, but that's another presentation.
Okay. Well, I'm not a very good golfer, so hopefully my trading is better than that. Doctor, very interested in seeing. Are you ready to start?
I'm ready to go, and I'll just you'll do the slides for me when I say next slide, I suppose, and I'm ready to
go. I got you. So
cool.
We're ready.
So let's launch right into the first slide if you want to get that going.
There we go.
Let's see. There we go. The vicious cycle. Love this image. Love this slide. So the title of today's presentation is Focusing on Process, focusing less on outcomes, and ultimately, is there a way to even let go of outcomes? Because that's the advice we often get, right? Focus on the process, let go of the outcomes. I mean, we've heard it a gazillion times, and it's very likely that you also know that it's a lot easier said than done. And I'm hoping that today's presentation and the Q&A that follows will actually help you to start to separate your process from your outcomes. And I'm going to talk today about why it's important to separate it, process and outcomes, how you can separate it. So as Hoag mentioned, you know, I've been doing this work for a long time, trading and coaching, and I've been a psychologist. And since 1995 or 96, thereabouts in the mid 90s, since that time, I've talked to well over 1,000 traders, probably a few thousand, and a very high number of them are, this is the independent traders mostly, but even professionals, a high number of them are boom and bust traders. Make a bunch of money and you lose it. Make a bunch of money and you lose it. And over the years, I've noticed one thing that runs in common across pretty much most of, if not almost, I think just about every single one of these boom and bust traders I've talked to. And also there's the same common thing I've seen in the boom and bust traders is also present in traders who hit a profit ceiling. So next slide, Hoag. And what this is that I come across, all boom and bust traders tend to have, and people who hit a profit ceiling, is they get caught they're caught in a bias, and the bias is known as resulting, or it's a self-serving cognitive bias. And what happens is, whether the boom and bust trader realizes it or not, they've conflated, they've merged, they've smushed together their trading process with the outcomes that they experience. And it has to do basically with how they think. And this is how most boom and bust traders think. If I had a good outcome, which is, you make money, that's a good outcome. A good outcome, making money, means it was a good trade. It means that it was a good decision to be in that, good job, pat myself on the back every time I make money. They also tend to think, anytime I lose money, a bad outcome, was a bad decision or it was bad luck. What I'm getting at here is that they equate their outcomes with their process. They smush them together. The questions you should be asking yourself continuously, as long as you are a trader every day, as long as you're interacting with the market, is it a good trade simply because you made money? Is it a bad trade simply because you lost money? And we're gonna kind of dive deeper into this here in a little bit, in a few more slides. These are really important topics that I think trip up a lot of traders that get caught in this getting reinforced or getting rewarded or getting paid for essentially bad behavior. And then they do the right things and they get their stops hit and they think it was a bad trade and they're afraid to take the next trade. It's a really, it's a vicious cycle, as I talked about in the last slide. So let's move on to the next slide, Hoag. In the professional poker world, there is a concept, I've mentioned it before, it's known as resulting. And former poker pro Annie Duke wrote about it in a recent book, Thinking in Bets, which, by the way, I highly recommend to all traders. It's a great book. What resulting is, resulting occurs when an individual equates outcome quality with decision quality. And both in poker and in trading, you can win with a poor hand and you can lose with a strong hand. There is a kind of a crazy mix of skill and luck that we face in trading, similar in poker. That's why these two endeavors, trading and poker, very similar psychologically, actually, probably the two most similar activities that I can think of, psychologically speaking. And recognizing this somewhat loose association between process and outcome, between luck and skill even to some degree, what happens is the better poker players and the consistently profitable traders, the ones that are not caught in the boom and bust vicious cycle, those folks have learned to evaluate their decision-making process as something completely separate from their outcomes. Psychologically speaking, this concept of resulting is a self-serving cognitive bias. It's actually sometimes just called the self-serving bias. Sometimes it's called resulting. Poker players like to call it resulting. Researchers, psychologists call it the self-serving bias. It's the same thing. It keeps traders trapped in a cycle of boom and bust. And I can just tell you that as a clinical psychologist and a trader who also dabbles in poker myself, not online poker, but I play in person pre-COVID, hope to get back to it one day. I see resulting as an example of what happens when trading process and trade outcomes become conflated, when they we smush them together. We think of them as similar. Next slide, Hoag. Among the most consistently successful traders that I know, and I know some very good traders, their trade evaluation is based primarily on the quality of their trading process, their decision-making steps along the way, each point along the way where they have to do something or make a decision, all the various aspects of their trading that they control, with the outcome seen as completely separate, because they know they can't control the outcome. That's the one thing that they don't control in their trading is the outcome. So therefore, they've been able to, they feel it's important to evaluate process separate from outcome. This is what the great traders will do. And this is what I do with a lot of my clients. Next slide, please. Actually, the really very successful traders, they kind of go a step further. What happens is this, they go beyond simply knowing and accepting that they don't control the outcome, because, you know, many of you listening to me right now probably already know and accept that you don't control the outcome. So these really great traders, what's happening is they're going beyond that, and what they've done is they've internalized it. It's something that is gone beyond simply an intellectual understanding. They will be willing to personally experience it. That's what I mean by internalize it. In contrast, boom and bust traders, they have this really outsized proportion, outsized concern, super intense concern and focus on outcomes. And this disproportionate concern and focus on outcomes for the boom and bust traders, that causes them, right then and there, that causes them to be ego-based traders. And when you're an ego-based trader, it makes it virtually impossible to ever let go of outcomes. You know, a lot of traders talk about this supposed holy grail of trading psychology, where you let go of outcomes, trade carefree, don't, just follow what you're supposed to do, follow your plan, work your edge, and let go of the outcomes, let them play out for themselves, let that take care of itself. Well, it's going to be impossible to do that if you're an ego-based trader. And if you're really disproportionately focused on your outcomes, then by definition, you're basically an ego-based trader. When looking at outcomes, there is always a luck factor. And many of my coaching clients know this as the third team concept, right? It takes, I think some of you folks who've been trading for a little while understand this. It takes other traders to move price one way or the other. The outcome of our trade is largely due to what other traders do. That's the luck part. You know, I've talked about how trading is this mix of skill and luck. It's not luck that we pick the right trade. What I'm referring to in terms of luck, it's once you're in the trade, it's what other people do is what pushes price either in our favor or against us. Evaluating a trade decision as a good decision simply because it made money, which is a good outcome, that is the quintessential example of conflating process with outcome in trading. And likewise, flip side of that coin, evaluating a trade as a bad trade simply because it lost money, that's also an example of conflating process with outcome. And the more you conflate, merge your process and outcomes, the farther you are from real sustainable success, the farther you are from breaking free of that vicious cycle of the boom and bust that many traders, I would say most traders, are probably in. This conflation also puts a ceiling on your success, limiting your upside over time. So the ego, what happens is our ego, it wants to conflate process and outcomes, okay? For an ego-based trader, the outcome of a trade feels like a referendum on whether you're good enough or not. This is what happens. Separating process from outcome is not easy in trading. I'm going to talk more about it here in a little bit. It's human nature to think that any good outcome, making money, regardless of the quality of the decision that led to it, was a good trade. Hey, it helps us feel good. However, the ego wants us to chalk up our winning trades as due more to our skill, and a losing trade more to something like bad luck or something that didn't come from us. Now, if you recognize that you have some of these thoughts, you're probably trading more based on your ego than you thought. And one could say that our ego is basically at the center of this kind of self-serving bias known as resulting. Next slide, please, Hoag. So, I've talked a lot about some problems here, and I want to start moving towards some solutions, some practical solutions. What can you do about this dilemma of being in the boom and bust cycle? realizing that just because you lost money, it may not have been a quote unquote bad trade. And just because you made money doesn't mean it was a good trade. So what can you do about all this stuff? Well, that's a problem, those things we're talking about, but there's also a solution. And here's one of the solutions. Eventually, you need to start accepting and internalizing that when you make money, you have to be honest with yourself and evaluating the quality of the decision or decisions that led to that outcome where you made the money. For example, in any given trade, you may or may not have engaged in a high quality process. Regardless, you put yourself into a position where you could benefit from what other traders are doing. It's their buying or selling that moves price. So what I'm saying here is I'm going to get into a certain exercise I'm going to want everyone to do, or I'm going to encourage you to do. I'm going to describe it here in a few minutes, but before I do, a little bit more about why it's important to do this exercise. Don't ignore the luck factor in profitable trades, okay? Because when you understand that others move price for us, it's not us, that will help to temper any overconfidence you may have. And I tell you, even boom and bust traders, struggling traders, unprofitable traders have moments of overconfidence, okay? Underconfidence and overconfidence happens all the time. So, if you don't ignore the luck, I would just say don't ignore that luck factor in profitable trades especially, okay? It helps to tamp down overconfidence for a trader. And as a trader, you got to remember, you did not cause the trade to work, okay? Regardless of what it felt like. Chances are, you're not a genius. You didn't know what was going to happen before. You're probably not psychic. Even if you are, you probably didn't predict what was going to happen. You simply put yourself in a position to profit from what others do. That's it. Don't let that get to your head. You did not cause the trade to work. So here's what we can do. Here's something I'm going to suggest you do. Something that I do, and it's something I ask some of my coaching clients to do if it's something that I think they will benefit from. And some do and some don't. Not everyone does it. So I would like you to consider sorting your trades into 4 different types. A type, and do this at the end of each day, and really look back on the trends, how many different trades you have in each category. A type 1 category, a type 1 trade, that's a trade where there's good quality process. For example, you followed your plan, and it was followed by a good outcome. You made money. That's a type 1 trade. A type 2 trade is where you had some good quality process. You followed your plan. You followed your guidance, your principles, whatever it is you're expecting to do, but you had a bad outcome. Your stop got hit, you lost money, but it was a predefined expected amount of money that you lost. That's a type 2 trade. We don't like them, but we all know they're part of the business. A type 3 trade is a poor quality or low quality process followed by a bad outcome. An example, there's a lot of different types of type 3 trades, but an easy example would be an impulse trade where you end up taking a loss on it, or you chase and you take a loss on it, or something like that. Poor quality process, negative outcome. Type 4, poor quality, low quality process again, but now you have a positive outcome. You actually make money. So you add to that loser, the crazy trading with your hair on fire kind of trade, or the impulse trade that pays off. Those are the type 4 trades. Very dangerous, by the way. Type 4 trades, dangerous psychologically speaking. They're one of the worst things you can do for your psychology is have type 4 trades. And I would say this, there's not a trader alive that does not have a type 4 trade, so don't get nervous if you're afraid because you have type 4 trades. I have them, we all have them. Some people just have many more than others, and some people just have very, very, very few. And usually over the arc of a successful trading career, you'll see fewer and fewer type 4 trades generally. So the thing is, even if once you have 1 or 2, it just creates this groundwork that, you know what, I could get paid off again for doing the wrong thing potentially. So that's a problem. If we know that type 3 and type 4 trades, low process trades, are bad for us, why do we still do them? Okay, because once you start your trades and start evaluating this, I'd encourage you to do this every day you trade. Put all your trades into one of four categories and look back on it at the end of the day. And then at the beginning of the next day before you trade, look back on the previous day's categories and where your trades fell. See if you can maybe set a goal. I'm going to reduce my type 3 and type 4 trades by 25% or by 50% this week or tomorrow or something like that, if you have a lot of them. So why do we continue to do type 3, type 4 trades, even though we know they're bad for us? So what happens is that in the moment when they occur, they provide some form of gratification. Some type of short-term need is met, a psychological need is met with type 3 and type 4 trades. Type 3 and type 4 trades are often, as I said earlier, they're often impulse trades. And an impulse trade can meet a variety of short-term needs. Some of these needs are conscious, that we're aware of, and some of these needs are subconscious, that reside in our unconscious, that we're not actually always aware of. In fact, many people are never aware of. So impulse trades can give an impatient trader something to do, right? Temporarily quell their intense FOMO. An impulse trade can provide some action for a bored trader who likes to gamble, perhaps. It can give the trader who feels behind on their P&L the opportunity to kind of quote unquote catch up or make their money back. These are just a few examples of the conscious short-term needs that type 3 and type 4 trades fulfill, why we do them for those conscious needs. There are also deeper, much deeper underlying subconscious needs, such as the need to feel good enough or the need to ward off feelings of not being good enough. And those are very deep subconscious issues that don't get resolved easily, but those are often at the core root of repeated mistakes. In other words, another way to say this is that when you repeat the same mistake over and over and you know it's a mistake and you know you shouldn't be doing it and you kick yourself and your logical mind says no, 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 but you keep doing it, the reason is because there's a very deep, powerful subconscious underlying motivation for that behavior. And until you're able to deal with that, you'll keep repeating it regardless of what you tell yourself why it's bad for you. All right, next slide. Hoag, please, thank you. So to succeed in trading, one could say that, as I've said, it's an activity of mix and luck, right? Luck and skill, I should say. We have to evaluate our trades very carefully because the brain is not designed to trade, okay? It is not designed to trade. You see here on the slide a quote from a researcher. I'm not sure if Lerner's still at Harvard. She may have left, but she was there several years ago, and this was a quote from one of her papers that she wrote. She's done a lot of research on behavioral economics and behavioral finance even. So this is not someone to be taken lightly. She's very familiar with investor mindset and even trading mindset. There is this is really critical to understand because our human brains really aren't designed to trade. In many ways, to succeed at trading, it means we have to override some natural human tendencies, okay? And among the many natural human tendencies that we have to override in trading or learn to override, we like to feel good. We seek comfort. We want to avoid, or we at least attempt to avoid discomfort. And we certainly want to be seen, whether you consciously would realize this or not. You might deny it, but it's there. We all want to be seen as competent and good enough. We do. And in trading, it's very easy to let short-term needs become the priority, preventing us from reacting, or I should say preventing us from reaching or increasing consistent profitability over time. The short-term needs, man, they really get in the way. The short-term need or desire to avoid discomfort, really, that's there all the time, right? We don't want to experience discomfort. That's a short-term need. Don't want to be uncomfortable. Don't want to feel anxious. And that shows up in a lot of different forms, right? It manifests in a lot of ways in trading, from waiting for our entry, feeling as though we might miss out while we're waiting. That's uncomfortable. Missing out, deciding not to jump on it and waiting, and then it goes and we're not on it, and that feels lousy. Missing out. Taking a loss, that feels bad. Even managing a winning trade, there's a lot of anxiety. Do I book my profit and then it goes on to be to leave money on the table and I'll feel like an idiot, or do I let it, hold it and then it comes back against me and I lose my unrealized gains entirely? There's that dilemma. Trading involves a lot of discomfort. It's discomfort, moment of discomfort after moment of discomfort after moment of discomfort. That's what trading's about. The traders who are able to tolerate discomfort greater and better, more resilient, are the ones that are going to do better. So the short-term need to the short-term need or desire to avoid discomfort and all those forms really trips us up, and it's a major developmental issue in trading. I mean, it's huge. It takes a lot of work to flip this around, to make longer-term goals more important than short-term needs for gratification. Because right now, for most traders, especially definitely the boom and bust traders, and probably 85, 90% of traders out there, they prioritize without realizing it. Their short-term needs for gratification are prioritized over their longer-term goals. They might think their longer-term goals are prioritized. They logically tell them that, but their behavior would tell me otherwise when I actually see someone trade. So what happens is, I'll tell you, one of the reasons I mentioned this earlier, and it's a big deal, is that it's not easy to flip around and make long-term goals more important and more immediate in front of us than short-term needs for gratification. It's hard to flip around because many of the unmet needs that we have deep subconscious roots. The advice we often get, focus on what you can control, process, and don't focus on what you can't control, outcomes, is good advice. It's great advice. I can't debate it at all. It's the type of advice we hear from, psychologists like me and business consultants, and we hear it in stress management training sessions. We hear it from therapists and performance coaches of all stripes. But the thing is, we all know that it's easier said than done, focusing on process and not focusing on so much on what we can't control. It's easy to say that, but how do we do it? Again, I'm going to tell you, as a psychologist, coach, and a trader, I've learned that a critical thing needs to happen before you can focus more on process and less on outcomes. And I say this as a psychologist, as a coach, and as a trader, because I've been through this all myself, for sure. You have to learn to separate process from outcome. And the first step in separating process from outcome is to learn to think of them differently. The second step is to evaluate them separately and independently. Without these critical first two steps, I'm going to pretty much, tell you that can kind of guarantee to some degree that you're going to remain where you are as a trader. You're going to remain a boom and bust trader, or if you're not a boom and bust trader, you'll never get past that ceiling that you keep running up against. All right, final slide to the takeaways. So, there's a lot more I can say about process versus outcomes, a lot more. I've really just scratched the surface. And I want to leave you with some final thoughts, okay? So before I talk about what's on the slide, here's a few additional final thoughts just from the top of my head here as I'm going through the presentation. If you're a boom and bust trader, or you're just stuck at a profit ceiling, there's a few situations that you probably experience on a pretty regular basis, right? Probably, maybe almost every day. And to end the boom and bust cycle, you're going to have to get past that ceiling. You're going to have to absolutely learn to deal with these two regularly occurring situations that probably may have happened for you today already, will probably happen for you this week if they haven't already happened. Always thinking that it was a good trade if you made money. If you think that you had a good trade simply because you made money, man, you got to check yourself at the door. That's not a good way to think of your trading. Also, if you're unable to accept in the moment and feel okay that a good quality decision can lead to losing money or missing out, that is very true. Good quality process can lead to a loss. It can lead to missing out. Until you can accept that good quality can lead to a negative outcome, until you can accept that, you will remain a boom and bust trader. Also, like I said earlier, always thinking it was a good trade just because you made money, that'll hold you back too. So the more you can engage in an honest evaluation of your entire process, like you see here on the key takeaways, separating process from outcomes to end that boom and bust cycle. You've got to evaluate your outcomes completely independently. And the more you can do that, the better off you're going to be as a trader, okay? The more you're focused on outcomes, the more you're more an ego trader in that moment, an ego-based trader in that moment. And there's a lot of different types of unmet needs that we have. We're aware of the conscious ones, but we're not necessarily aware of the subconscious ones. And it's those subconscious ones that usually trip us up the most. And so there's, this might be a good place, Hoag, to just say, I'm just going to say that, what I've talked about is some pretty important stuff, I believe, in training psychology that doesn't often get talked about. And it's one thing to know this stuff, and it's another thing to accept it. And yet it's even another thing to internalize it. And that process from just knowing it, hearing it, knowing it, accepting it, and then finally internalizing it, it's not easy to do. And it doesn't happen overnight. And, you have to learn to commit to the ideas, and you actually have to do some work on it. So with that, I think it's a good place to open this to Q&A. So I'm ready to go. Yeah.
Doctor, thank you so much for this presentation. I'm sure that a lot of folks have been writing lots of crazy notes. Don't forget, folks, this is recorded, so you will be able to hear it again once it's compiled and everything comes back. So many great things. Just to touch on a few is, everybody talks about the ego and the self-esteem when it comes to trading. And while you are controlled by your ego, you're not going to be able to maintain the humility it takes to be honest about reviewing your process. How do you let go of your ego is a big part of it. I loved what you said about the luck factor.
Mm-hmm. Mm-hmm.
It's not, we're not making the market move, others are.
Yeah, we easily forget about that. To come back to that question, I think what I heard in that question, correct me if I misheard, but something about, how do we let go of the ego, I think is what I heard in there.
Yes.
So, I'm going to be very practical, okay? And what I'm going to tell you is that I don't necessarily think, that it's possible to really let go of the ego, okay? Especially living in Western society and our culture, okay? Maybe if you're living up in the mountains, in Tibet, maybe you can. I don't think it's really possible to let go of the ego, because if you don't have an ego, that means you have no desires. If you have no desires, you're not going to want to trade because you're not going to want to make money. So this idea of being ego-free, egoless, and letting go of the ego, not a good idea. Letting go of outcomes, or I should say being less attached to outcomes, is much more practical. And I would suggest that's where you put your focus to. Now, there's things you can do with the ego, managing ego, working with your ego, developing awareness around how can I get my needs met in a way that is that's healthy, that's in my best interest, that's congruent with my longer term goals. So there's things you can certainly do with your ego, but to say you want to become ego free or to let go, I don't think you would do very well in trading. You probably would actually lose interest in trading.
So would you say that having an ego based on good processes, your sorting process for trades, your 1, your 2, having a pride or an ego involved in sticking to that good process could be a way to remove ego from the ugly part of trading, would you say?
Yeah, I think I hear what you're saying, and I probably should have done a better job of this, Hoag. I think you're kind
No,
of
not at
at me
all.
here. What I should have said is I should have said, it's not about getting rid of the ego, and I talked about, ego-based trading is not good. So that kind of left people with like, well, how can you not, ego-based trading is not good, and he's saying we shouldn't get rid of the ego. Isn't there a conflict there? What I'm saying is that ego is going to be there, so we have to learn to work with it. And the main thing is you don't want it to be driving the car while you're trading. Okay, it's going to be there. So when I mentioned ego-based trader, what I probably should have maybe clarified or specified, you don't want the ego to be in charge like all the way, pretty much have the final say over everything, or just have where most of your mental energy is coming from, because then it's a problem. But you can't completely take your ego offline. It's not possible.
Thank you, Doctor. Your 3 and 4 sorting trades, of course, we've all made them. I know I've made plenty of 4 low process wins, and every time I do that, I just have to try and remind myself that that was just luck, and I don't want to count on luck the next time I see a low process opportunity. So when you were talking about, we all want to be seen as competent, short time frame needs sometimes overweigh consistency in longer term goals. Is that a degree of maturity, you would say, being able to delay instant gratification for future gain?
Boy, good question. That's a hard to answer that quickly. There's an aspect of maturation to that, but that's not entirely it. There's also, you can gain experience quickly without having to kind of go through kind of the time-based maturation process. So there's different ways to kind of, for me to answer that, but in general, there's other things you can do. There's an entirely different way to consider the issue, which is, can you also get those needs met in other ways? So they don't have to be met in your trading. In other words, what I often will see is traders who are very unfulfilled in their personal life for whatever reasons, relationship-wise or emotionally, or just enjoyment, or just whatever may be happening in their life, and they're really trying to seek fulfillment from the market continually, and so that sets them up to need to get the short-term gratification needs met. They're going to just be really powerful for them.
So the experience can do a lot of the maturation as long as
Yeah.
you're doing the experience.
Yeah, and I think that, boy, this is a tough one, but realizing that you can survive, not just financially, but psychologically, you can survive taking a loss, a predefined loss. You can survive not being on that move that you want it to be on, but it's not necessarily, part of your plan, and you recognize in that moment it's kind of a low process thing for you. The acknowledgement, the recognition, the acceptance in the moment that I can survive this difficult emotional experience of not being fulfilled. When you start to make have conscious experience of that results in some maturation. You begin to get a bit of a handle on those short-term needs that want to be met all the time.
And one of the last things I want to say before I kind of dig into some of the questions here is, you said something many years ago that keeps ringing in my ears, and something that I have kind of borrowed from you is, you mentioned the whole thing about discomfort. Whoever is the most able to withstand discomfort wins. You told us a long time ago, get comfortable being uncomfortable.
Yeah, exactly. Boy, I see that so much. Hoag, I see it so much. It's like, as I mentioned, trading involves a lot of discomfort, all the waiting for your entry. Once you're in, is it going to work? Is it going to work? Having to take the loss, or experiencing missing out. I mean, there's just discomfort. There's constant discomfort. I mean, yeah, we have days and moments where we feel great, but we have to remember there's lots of moments where there's lots of discomfort. And like you were saying, Hoag, it's the traders who have a greater ability to tolerate all the discomfort are the ones who don't act out on it. They're not, in therapy, we call it acting out, or some people might think of it as reacting. We're not acting out on the emotions of that discomfort. And that's, that's really the difference between the traders that make it and the traders that don't.
Okay. One question from one of our viewers. When I started trading, I reacted to losses very negatively, and we all do, right? I would feel very threatened by losses, and when they came, I was put on tilt very easily. These early days in my career have formed a bad habit of fearing losses. My aversion to losses is so strong, I will do anything to prevent losing. Of course, this means that I will hesitate on taking trades that end up working. This creates frustration and anger, and I start to force trades, of course, lose. This is a vicious cycle that often feeds on itself. My question is, how can I accept losing as part of the game? I want to be able to put a trade on without fearing the potential loss, because the probabilities and risk to reward are on my side.
Okay, good question. I was hoping, I would assume that someone would ask a question like that. And the best answer I can give you, first of all, I'll just say that, I never really, honestly, as a trading psychologist, I'll be, really candid here, and I'll just say that oftentimes I don't really know what's going to resonate with the person I'm talking to, what's going to move the needle for them. And since I don't know this person, it's because there's a lot of ways I can answer that question, and I don't know what will land most with this person. So I'll try maybe a couple of things here. So one thing would be that if you can bring yourself to the point of, as we talked earlier about how outcomes are up to the other traders, right? It's not up to you. So if you take a loss, it was not your fault. You didn't pick the wrong trade. To start to recognize and internalize that a loss does not mean you did something bad. It's not a reflection on you. It's what other traders did. Okay. So that's one way to look at it. That's a bit on the surface level, and that's what I call the every person's psychology, right? It's the stuff we all have in common. Now, going down deeper into the layers of our psyche, I'll skip a few layers and I'll go pretty deep, and I'll say, I'll just ask out loud, not that the person has to type it in or say anything, but could you potentially have issues around endings or losses and other areas of your life? Because oftentimes what happens is I will see examples or a parallel or a transference of a psychological dynamic in one's life that they bring into trading with them. So I'd be wondering about that as well. I'd be wondering about, has this person, when they have had losses in their life, what was it like for them? How did they react to it? How did they recover? So I'd be wondering about kind of the idiosyncratic individual aspect of it for the person, and they should be thinking about it as well. But this idea of when we read trading psychology, for instance, like, Mark Douglas comes to mind. I was talking to somebody the other day about Mark Douglas. A lot of good ideas in there. One idea that I would just suggest that may not be helpful for you when it comes to accepting a loss was his idea of trying to develop a carefree mindset. I don't think you can become carefree. You're gonna experience some negative emotion around losses, and so what I'm saying here is that if you can realize and internalize, it's beyond realization actually. When you internalize that a loss in a trade, if it was a trade that was part of your edge, right? It wasn't just some impulse trade or some chasing situation, but if it was a good process trade, that loss has nothing to do with you, and it will take some work to be able to accept that, because we get this immediate feedback in the form of our P&L. We look at it, we go, oh my God, I have less money than I had on my account a few minutes ago. I suck. I did something bad. What did I do? I got in the wrong trade. That was stupid. I need to make it back. All that self-talk, when that starts running, what you need to do is start, rather than letting that self-talk and all those feelings and emotions just run around your head, which will probably lead you to get into a revenge trade, like you mentioned, get your pen and paper out and start writing down all the stuff racing around in your head. Put it on paper. Don't censor it. Get it out on paper, because if you keep it inside and keep it bottled up, there's a high probability that you will act out on that stuff and you'll put on that revenge trade. So yeah, write down what you're feeling, why you're feeling it, explore and dive into, in as much depth as you can, as many words as you can. Don't censor. There's no right or wrong with this type of writing. I call it drill down writing. You do it as much as possible to help bleed off the emotional energy so you don't act out on it.
Probably how a lot of songs were written. I think, similar kind of question. The question is, how do I stick to my process while in a drawdown? I know every trade is unique and has nothing to do with the previous trade, but memories of loss are painful. I fail to see this reality in the moment.
Yeah, well, a few things in that. So yeah, the memories of, memories around specific, or I should say highly charged events, or events that we remember, there's a reason why we remember certain events more clearly than other events, whether they're trades or not. It's because those are events that had a higher emotional charge to them. Emotion and memory are very connected. So, so this is a tough thing. And what's going to happen is, we're going to remember all those times. And to get to this point of, I think this person in their question talked about, realizing that there's just that 50-50 probability. That's great to tell ourselves, but that's intellectual. And what I will tell you is that when it comes to behavior change, it's really hard to use an intellectual tool for behavior change. Behavior also is driven by our emotional energy, like Jennifer Lerner from Harvard would talk about, and many others, not just my opinion. It's a lot of research on this. Behavior is also driven by emotion. And so if you want to change behavior, you got to work with emotion. And one of the ways you can work with it as a trader is explore your emotions, attach words to your emotions, express them, put them on paper as much as you can to get them, give them a place outside of you. So they're not just bottling and just storing up, or I should say accumulating. The energy, literally, it accumulates, and eventually it finds its way to your trigger finger, and bam, you hit the buy or the sell button.
So check me if I'm wrong here. What you're kind of saying is the higher the charge of the emotion that is stored in your brain, the faster it is recovered.
It's not linear like that. I know a lot of traders, they want linear concepts. It's not that simple. There's a correlation in terms of typically things that we remember better have a higher emotional charge. And the memory is not always factual, right? We remember things the way we want to remember them also. That's another really big piece. Memory is constructed. It's not entirely factual.
Okay, another question. So I have times where I have a lack of confidence, but this isn't fear with classic fight or flight response, no elevated heart rate or anything like that. But it's a gray area, but I'm not sure if I should look at this from the emotional side or the technical side, looking at it as lack of information. Is there some type of exercise to differentiate which one I'm actually dealing with?
What was the first part of that question again, John?
Okay, so I believe he's having times when there's a lack of confidence, but it isn't necessarily fear or classic fight or flight or no elevated heart rate or anything like that, but it's kind of more of a gray area. But he's not sure if it's emotional, which, without the fear or the elevated heart rate, I'm not sure if that's if it's emotion or if it's a lack of technical side, looking at the information, looking at the charts, looking at an opportunity and saying, well, technically I'm not really seeing, I'm not really feeling it. What am I doing?
Sure. No, I think I got the question now. So first of all, we'll never have complete information, right? You can get every piece of software and indicator and all the stuff that's out there for sale, and you'll still not have enough information, right? Well, we, as traders, we're playing a game with imperfect information, like in poker, right? You're never going to know what your opponents are holding or what hasn't hit what hasn't been dealt yet. So we're playing a game with imperfect information. So I'm going to say the technical stuff, the reason why you're experiencing this is you might be telling yourself, you might think it's because you need more information. And I'm sure there's an aspect of that perhaps is true, that you think you need more information. But I'm going to suggest otherwise, that I think there's something else happening in addition to thinking you need more information. This person talked about, not having the fight or flight, not having an elevated heart rate, not feeling emotion. So therefore not quite sure, they kind of felt neutral. What I'm going to say is this person might, maybe, and I could be very wrong about this. Hopefully maybe this person will send me an email if I'm wrong. I kind of wonder if this person actually is having emotions, they're just not realizing it or recognizing it as emotion. I wouldn't be surprised, like if I was there in the room with this person and they're going through this, I could probably look at them and I could probably sense something about their body, maybe their posture changed, maybe their breath, respiration rate changed, something has changed. Very often we express emotion in our body first before it becomes a mental experience, or we recognize it as anxiety or anger, or we have this like.
Usually for me, it's my clicker finger. It's my, right?
Yeah. Yeah. So I would say that, maybe this trader should clue into maybe some other aspects to themselves that there may be some signs of emotion there. That's what I would first check out with this person. If I was working with this person, I'd say, hey, let's not assume that you are neutral. Let's like in medicine, you got to rule out the diagnosis. So let's rule that out first. So let's see if there's any evidence for it before we can rule it out. I wouldn't want to rule out that the person is completely neutral, because humans are emotional creatures, and just because you don't think you're feeling emotion doesn't mean you're not having it.
Maybe it's a little bit of protecting himself from those emotions, perhaps, in that situation.
Yes, thank you for saying that, Hoag. I could have easily said that myself, but thank you for saying it. Yes, exactly right.
I'm incapable of hiding emotion. Everything I usually think or feel is right on my shoulder or on my sleeve. So, but I'm sure that we're all humans, and we all have that same tendency at certain times, for sure. All right. So, speed round. Are there any recommended books for improvements in trading? Go for it.
Yeah, I mentioned one in the presentation, Thinking in Bets by Annie Duke. It's a former poker pro. Great book. A lot of psychology in there. It's not just about poker, but it's very applicable to trading. That's a really, really, really great book. Another book that I'm going to talk about I'll mention it's called Permission to Feel. Permission to Feel, written by a professor at Yale, a psychology professor who was kind of one of the originators around emotional intelligence. And it's the idea behind the book is this. Neuroscientists, neurobiologists will tell you, because the research shows this, that we are emotional creatures. We have logic and we have reasoning, but that logic and that reasoning is very intertwined, and it's been shown pretty much conclusively in the brain with brain scanning that you can't separate emotion from reasoning. They're intertwined. And so what this book talks about is, we've kind of learned to kind of tamp down our feelings and emotions, and because they're seen as a weakness or an obstacle or a problem, or they get in the way of our goals. And it's become a problem because people are walking around with bottled up feelings that leak out and we act out on in the worst possible time sometimes, that are not, kind of screws us up. So this book, Permission to Feel, is about allowing yourself to feel your emotions and giving you a way to do that. And I think I've had some traders read it. It was very helpful for them. I have found it to sort of be a good adjunct to my coaching sometimes. So Permission to Feel, Thinking in Bets, two great books. Also, the Jesse Livermore Reminiscences of a Stock Operator. I recently reread that probably for the 7th or 8th time this few months ago. Great book, a lot of wisdom in that book.
That one seems to be a fan favorite wherever we go, isn't it?
Oh, it's a classic, timeless. Yeah.
Okay. Why are some traders good at different paces in the market? I'm saying some faster, some slower. What makes it one trader better at a certain market pace, let's say?
Yeah, well, there's a lot of variables. One big one is actually is age. I will say that as someone who's 58, be 59 this year. When you're younger, you're faster. Typically, as we get older, we do slow down a little bit. So that's one factor. Personality. Yeah. Personality is another factor. Definitely, right? Some people are just keyed. Their personality is such that they just, they like action, they want action, they're looking for action, and so they're going to operate faster because they constantly need stimulation like that, or new, fresh stimulation. Others don't. And so and I would just say this, there's a lot of different ways to participate in the market, and what's right for you, is going to be what's right for you, and it's not going to be what's right for someone else, and it's finding what's right for you. And quick thing I'll just say about that, because there's been, a lot in the past about this. Hey, can I take a test? It'll tell me, a personality test or something like that. It'll tell me what kind of trader I should be. Well, I will just say this. As a clinical psychologist, I used to do a lot, before I worked with traders, I used to do a lot of threat assessment. In fact, I did some threat assessment even when I was doing some work with traders, kind of overlapped a little bit for a few years. And doing that kind of work, what I've learned is that and all the threat assessors will tell you this, FBI, all those guys will tell you this, that if you do a paper and pencil test, it's called a structure test or a personality test, you get some good information from it for sure, but nothing can replace a good clinical in-person interview where you're watching the person and you're giving them certain difficult questions and seeing how they react, looking at for their body, nonverbal, not just what they're saying. You get a lot more information. So what I would say is taking a test to find out what kind of trader you should be. It may help a little bit. It probably won't hurt, but it's probably not going to be the panacea that you think it's going to be.
All right, we're getting a little bit late here. I've got one more question for you. You got time for it, Doctor?
Sure, go ahead.
Okay. Is having OCD tendencies a benefit or hindrance in becoming a consistently profitable trader?
Oh boy, and you made that the last question, Hoag. Thank you. That was planned. Boy, geez, never been asked that one before. I could see it going both ways, man. I could see it becoming a big problem, and I could see how it could help at times, right? I could see it going both ways at different points along the journey for a trader. So, and I'm sure there's probably some successful OCD traders out there and some spectacularly unsuccessful OCD traders that really, I think it's split. I can argue either side of that one, actually.
I was thinking the same thing. If your compulsion is keeping you consistent on good process, then
Yeah.
could.
Depends on what you're obsessed with. Exactly right. Yeah.
So, all right, Doctor. We've got just a couple of minutes left. I want to say thank you very much, and I know that everybody, if we could hear them, would be clapping and thanking you tremendously right now. Can't say enough, and I look forward to having you back and having you back again soon.